2022 is going to be an interesting year financially. We're going to keep seeing records amount of national debt, money printed irresponsibly, lower interest rates, and the Fed continue pushing for higher inflation. All these things can make investing rather confusing, which is why in today's video, I want to discuss how you should be investing in 2022. If you're new to this channel, I'm Dr. Jeff Anzalone, a periodontist whose goal is to teach you how to reach financial independence by leaving the rat race with passive income. You can download the free passive income guide with the link below this video. I talk to new passive investor circles members on a weekly basis. Some are fresh out of training, maybe in their 20s, late 20s, early 30s, while others are actually older, approaching retirement. And it seems to me when I have these calls that the younger generation are a little more in tune with investing in things like crypto and assets that actually produce passive income, such as real estate, whereas the older people, they tend to stick to traditional asset classes like stocks and bonds. However, if you're only investing in crypto or only in real estate or only in stocks, then you're missing out because each of these three asset classes can actually provide a combination of both growth and income. And I believe the best approach is to first understand all of your options out there and then decide where best to invest your hard-earned money. In this video, I'm going to go over the pros and cons of investing in stocks versus real estate versus crypto, which is actually going to be pretty fun. And we're going to get into the market dynamics and the economic conditions you need to be aware of right now. And stay tuned because at the end of the video, I'm going to leave you with some tips of how best to decide where to invest your money in 2022. I recently heard somebody call into the Dave Ramsey show and ask his advice. And he said, "Hey, Dave, should I invest in stocks or should I invest in real estate?" And the caller felt that the price of stocks these days was completely irrelevant to some of the different earnings that the companies are reporting out there. And he wanted to know if his money would be more effective in real estate instead. And Dave's answer actually surprised me because he felt that if somebody did a really good job with real estate, then they'd actually make a much larger return versus being in the stock market. But he did say it would take up more of your time versus investing in stocks or mutual fund and then not having to worry about it. He claimed that stocks had something called a zero hassle advantage versus real estate. But he was actually talking about somebody being an active real estate investor. And those are the ones where you self-manage. So you have to deal with tenants, you have to collect the rent, you got to fix stuff when it breaks. And you're the one in charge of keeping it rented out after your tenants move out, or you have to kick them out. Dave wasn't talking about the kind of real estate that I personally invest in, which are called real estate syndications. And they actually act like a mutual fund. What you do is you put your money in one time, then 6 months after it closes, you start getting a check every quarter, which is a passive income stream. And this happens during the whole period. These syndications that I typically invest in, they have anywhere from probably like a 5 to 6 year hold period. As of this recording, I have 8 of these going on, plus the income coming in from my practice. And the main reason that Dave thought that real estate would outperform stocks in the long run has to do with something called an imperfect market. Now, a perfect market is one where all the buyers and the sellers have exactly the same information and the exact same process to buy. And so when you think about it, the stock market is closer to a perfect market versus real estate. Now, in real estate, each item is unique to a certain area, and all buyers and sellers, they never have even close to the same amount of information or belief about a piece of real estate. So, for example, if I'm selling my house, I can guarantee you that I'm going to think it's going to be worth a lot more than whoever I'm selling it to. And because real estate gives you a lot more opportunity, Dave thinks that you can get better bargains with real estate. And this is why he thinks that real estate outperforms stocks in the long run. Also, real estate, and we've mentioned on previous videos, it actually has 3 types of return. And this is important for somebody that like myself and hopefully you want to reach financial independence as soon as possible. And the three returns that you're going to get with real estate is The first one is appreciation. So whenever you buy a property or if you invest in a syndication, over time it's going to go up in value or appreciate. Second would be the cash flow. This is the passive income that we're going to receive from the rental income. And the third return is going to be tax benefits. You actually get to depreciate this property. The IRS gives you a tax break, which is one of the main reasons many people, many investors out there get into real estate in the first place. Now, when it comes to stocks, you actually have two returns. And the first one is, whenever you buy a stock, hopefully you want it to increase in value or go up in stock price. And the second type of return, and I put possible here because there are some certain stocks that you can get that actually pay out dividends. So it's a potential another source. And these are the profits that are shared with the owners of the company. Now, remember, when you're a stockholder, you're actually an owner of the company, which is actually a pro of investing in stocks. But there are some people out there that think investing in the stock market is like going to a casino and gambling. And they tend to think back at what happened during the tech bubble. That would be 99 and 2000. Now, this was the rage back then. You may or may not remember when there were a lot of people that were buying these stocks in these tech companies. And the problem was these tech companies, they never made a profit. I remember at this time, I was actually in dental school. I was broke with no money, and I would turn on the TV when I would get home each day, and I would see all these companies going up 40, 60, $100 a day or more. But at the end of the day, the majority of these companies didn't survive because, again, they never made a profit. But there were a few that did survive, like such as Amazon, that are still around today. Personally, I don't invest in any individual stocks, but I do invest in mutual funds, which are nothing more than a collection of stocks. But to address the comment comparing the stock market investing, investing in stocks to a giant casino, if you know what you're doing, there really is a big difference. So, for example, if you invest in McDonald's stock or Apple or Home Depot, then you're betting that actually those stocks are going to be worth more, let's say 5 years from now, than they are today. In essence, you're gambling, yes, but there's something different that you can do versus going to a casino and playing blackjack or craps. With these companies, you can actually look at their track record of growth, the stock price growth, and the management team, and then you would look at the profit margins, and then from after you get that information, you can project that into the future. You can predict what you think the business climate is going to be that they're in now. Let's say you want to buy stock in Home Depot. Then you would look at how the company is doing now and determine if you think it's going to continue to grow and their profits are going to continue to grow. So for this example, let's say that last year Home Depot opened up 400 more new stores, and all of those stores right now are making a profit. So now when you look at everything, Home Depot has 400 more profitable stores than they did the previous year. So as long as these companies are going to continue to diversify and grow and adding profits to their bottom line, then it only makes sense that their stock is going to continue to be worth more in the long run. And so technically, it's not a casino because a casino is truly a game of chance, right? You have nothing to analyze there, whether the dice are going to roll your way or if you're playing blackjack and a face card and an ace are going to turn up. Now, while we're on the topic of stocks, let's briefly get into the pros and cons. So the first pro for stocks is it's very easy to invest. So right now you can pick up your phone, you can click on a number of apps such as Robinhood, and you can start investing right away. The next pro is investing in a stock. It's a very liquid investment, meaning that you can invest, let's say, 50 grand. Then, if you need to, you can get that money out quickly, for any reason. And then you can convert those shares of stock to cash. And then now you have all this cash, which actually gives us our first con that investing in the stock market is or investing in a stock is what's called a paper investment. Remember early on in this video, when we talked about when you invest in a stock, you become an owner of a paper, own paper. Well, if the manager of the company actually runs it into the ground and it goes bankrupt, unfortunately, you'd lose everything. Whenever you invest in stocks, you don't own anything tangible, so you can't see it, feel it, touch it. You're basically just an owner on paper. All right. So here's another pro. Whenever you invest in stocks, there's actually no physical work required. Now you can go right now and you can buy, let's say, 10 shares of Apple stock. You become one of the owners of that company, and you get to actually share in the profits when Apple makes more money, but you don't have to physically go and work for Apple. You're one of the owners on paper, and you get to share the profit without doing any of the work, which actually leads us to a con when investing in stocks is you have no control. Basically, you have no control over your investment in that stock. Again, if you invested in a company and the managers run the company into the ground, there's not a whole lot you can do with it. Yes, you do have some voting rights, but you can't really go there or call them up and tell them how they should actually run the company and what they should do. You don't have that type of control in the stock market. All right, so now let's shift gears and let's discuss real estate. And the first pro that it comes to when you invest in real estate is that you own something that's actually tangible. You can see it, you can feel it, you can actually control it, you can manage it if you want. So, for instance, if you bought a house as an investment, then you can drive by, you can see the house. You can actually walk into the house. You could control what kind of appliances there are, what color you want to paint the walls, whatever. And you can manage your investment property exactly however you want. And this added control actually gives us our first con with real estate investing. There's actually more work that's required whenever you invest in real estate. You have to make sure all the bills are paid, the maintenance is done in a timely manner, and that your tenant actually pays on time as well. Now, I have two responses to this. The first is if you decide to go this route, this active investing route, where you do all of this yourself, at least do me a favor and consider hiring a property manager to handle this for you, to take all of this off your plate for you, because they're the ones that they're going to handle all the work, and you're working basically as the investor to find more investment properties instead of actually having to go physically manage your investment. Or you could do what I do, plus many of my passive investor circles members do. And remember, we invest in these real estate syndications, which we talked about earlier. Now, if you're an accredited investor and you want to know about the deals that I personally invest in throughout the year, you can do so by joining our group for free. And I'll actually put a link below this video as well. All right, so the next pro for real estate is that you are investing for cash flow. You are actually creating passive income streams when you invest in real estate because you're going to get paid monthly if you're an active investor, or if you're like me, quarterly. The money this money, this passive income, it's going to come in whether or not you go to work, because guess what? Your tenants pay the rent. I don't have to come here and treat patients when I have these types of investments, because if I have enough of this type of money coming in, it's going to replace the income. Now, when you do this, you're actually creating income today that you can either use to reinvest for future, like I'm doing, or you can use it to spend it today if you need to. The next con regarding real estate investing is that starting starting the whole process, starting takes more work as well. Now, remember, if you wanted to invest in the stock market, you could just simply go to your phone, go to the computer, open up a brokerage account, and then start investing ASAP. But if you want to buy real estate, you would have to be the one to first find a property that you want to invest in. Next, you're going to have to secure the financing, right? Either from a bank or other investors, or a combination of both. And then you have to find or put together all the team players that are going to help you with this process, such as real estate agents, attorneys, um, CPA, property managers, contractors. So again, there is a lot of work to get started. And because you invest in something tangible, again, your money is not going to be liquid in real estate like it is in stocks. So this could easily take 30, 60, maybe 90 days for you to actually list your property to sell it. And then you sell the property and then you get the cash from this. Now, another pro with real estate is that it has some of the best tax breaks, best tax benefits that our entire tax code has to offer. You can make a profit from your real estate income and actually show a loss on your taxes with all the deductions. And what happens is your real estate over time gets depreciated. The IRS allows you to write this off called depreciation, which actually you don't get that anywhere else. Additionally, let's say that you invested in the stock market, okay? And you invested $100,000 years ago, and you've actually turned that $100,000 into $1 million over time. Now, you would have to pay taxes on that $900,000 gain, but if you took the $100,000 and turned it into the same $1 million in real estate, you'd actually pay, or you could potentially pay zero in taxes today if you use something called a 1031 exchange. So basically, what you would do is you take all that $1 million that you just made, and you can reinvest it into another property, which allows you to pay zero taxes on that. So now you see why real estate has some of the best tax breaks out there. So now we talked about stocks, we talked about real estate. So now let's shift gears and briefly talk about one of the hot topics out there, that's cryptocurrency. Now, one of the biggest pros out there is that cryptocurrency has drastically outperformed stocks over the long run and real estate in the last 10 years by, some of the top coins like Bitcoin and Ethereum. Some of these coins, you've probably heard of stories where people have just initially just taken very small investments and they've made big money on it. Now, as of this recording, Bitcoin has been averaging close to 200% a year for the last 10 years, which is just unbelievable when you think about it. Another pro is something that many aren't aware of, and this has to do with when you invest in cryptocurrency, you can actually get passive income from it. You can actually generate this income simply by holding your coins, your cryptocurrency, on different exchanges out there. Cryptocurrency generates interest just like banks, where they can actually make money by what? Lending it out to customers. And these companies out there, these crypto companies, what they'll do is they'll lend out their customers' crypto deposits in exchange for interest. Now, I'm currently doing this as we speak on a site called BlockFi. Now, if you hold some of your coins on some of these different types of exchanges, they'll actually turn around and lend out your crypto to other individuals, to other businesses, maybe to other exchanges, places that need to borrow crypto, and they'll charge higher interest rates. Then they'll pass on about 80% of that to you in the form of rewards that you get each week. So think about it. Not only can you simply hold something like Bitcoin wherever you buy it from on an exchange, and it's going up an average of 200% a year, you can also take this, hold it on a different exchange for passive income that you can actually use while it's being held. Pretty cool concept. Now, if you want to get started with this, what I'm personally using with BlockFi, you can do so by clicking on the link. I'll put that below the video. So clearly the passive income from crypto is great, but the trade-off is if you want to invest in crypto, you're going to have to stomach some big time volatility, which is actually one of the biggest cons out there in crypto, the big fluctuations up and down. Now, in 2021 alone, Bitcoin went from about $10,000 up to $60,000, then back down to $30,000. And now, right now, as of this recording, it's hovering around about the $50,000 mark. It seems that really all it takes is just somebody to, maybe somebody famous like Elon Musk, just to tweet something, and then, you never know what's going to happen. You never know how the market's going to react. Even though cryptocurrency is extremely volatile, there are some ways to use the volatility to your advantage. One, you can do something called dollar cost averaging. And this is a strategy where you actually buy the same dollar amount of an investment at regular recurring intervals. You can do this weekly, bi-weekly, monthly, or whatever interval you choose. When I started investing in Bitcoin earlier this year, I started off by investing a certain amount of money each week. This means that each time I bought, I'd acquire more Bitcoin at varying price levels. So the amount of Bitcoin that I get for my investment will vary when Bitcoin is high versus when the price is low. This helps in, psychologically, people are trying to time the market. But the thing is, you may not realize, unlike the stock market, the crypto the crypto markets are open 24/7. They never close. So, if you're always trying to time the market, you may miss out on a drop in price because you're not always being able to be awake to see it. So if you just set an amount, certain amount, then you're going to catch some of these highs, but you're also going to catch some of these lows. Now, understand that we covered a lot of information today, and you're probably wondering, well, hey, Jeff, how do I decide where to invest my money in stocks, in real estate, or crypto? Um, I feel that at the end of the day, diversifying by having some money in all three asset classes is a great approach. Now, look, I'm a periodontist, I'm not a financial advisor, so don't take this as investing advice. Take this advice maybe as if you and I were just sitting down having a casual conversation about investing, and this topic comes up. So, first of all, what you're going to want to do is what you're going to want to do is going to be different than what somebody else is going to want to do versus what I want. So the first thing that you should do is figure out exactly what you want. What exactly are you trying to accomplish financially? Personally, my goal is to exit practice in 5 years or less by getting my passive income stream, by getting my passive income that comes in every year to exceed my active income. Once I do this, I'm financially independent. Now, I have certain numerical targets, throughout the year that guide me to see how I'm doing, and I'm occasionally checking this to see, how the progress is being made. Now, if you haven't done that yet, really, that's the first place I would recommend that you start. And I personally have a mixture between stocks, typically in the form of mutual funds, mostly index funds. Some of these are in our practices retirement accounts. Others are in a brokerage account. We also invest in mutual funds within our 529 plans that we have for each of our kids' college funds. Some of our excess cash that we have, we hold that in crypto, and then others we have just in a traditional money market account. And then the bulk of our investing now, any leftover money, is now going into these syndications in order to help me meet my goal to build up that passive income that I just mentioned. Now, it's really, once you boil it all down to it, it's really up to you to take care of yourself financially. And the best way to do that, I can think of no better way to do that, is by putting your money to work for you instead of you always going to work for it. If you want to learn more about my own personal investment strategy for wealth creation, I've made a video just for you that you can check out right here. I'll see you over there.